Hey everyone, welcome back to Corporate Decoder, the place where we unpack the confusing world of business and finance. So N.L.I.G.H.T Incorporated filed their latest quarterly report, and it looks like they've been navigating some interesting currents. Let's dive in. First off, N.L.I.G.H.T Incorporated is filing their quarterly report, a Form 10Q. This is basically a snapshot of how they are doing financially and operationally over the last 3 months, ending the 30th of September 2025. We're going to cut through the jargon and find out what these numbers really mean for the company. Before we get into the nitty-gritty, let me ask you this. If you enjoy getting hard-hitting financial analysis without the fluff, make sure you are subscribed to the channel. And hey, if you like to chat about this stuff and break down these reports with other finance enthusiasts, we have a growing community over on Discord. The link is in the description below. Let's start by looking at the big picture, their balance sheet. As of the 30th of September 2025, N.L.I.G.H.T Incorporated had total assets of nearly $300 million. That is up from around $270 million at the end of last year. This increase is mostly due to a jump in their current assets like cash and inventory. Their cash and cash equivalents went up significantly from about $66 million to over $81 million. This is a good sign showing they have more readily available money. However, their inventory also climbed, which can sometimes mean they are producing more than they are selling, and that can tie up valuable cash. Now let's look at accounts receivable, which is the money customers owe them. This also saw a healthy increase from about $35 million to almost $50 million. While this sounds good, it also means more money is tied up in customer payments. And with an increase in allowance for doubtful accounts, we need to watch if they might have trouble collecting some of this money. Moving on to their income statement, which shows how much money they made and what it cost them. Their total revenue for the 9 months ending the 30th of September 2025 hit over $180 million, a good jump from about $151 million in the same period last year. This 19% increase is mainly driven by their aerospace and defense customers. Specifically, product revenue saw a solid bump, especially compared to last year's numbers. Development revenue also grew, which is interesting because it signals continued investment in new technologies, likely driven by those defense contracts. But here is where it gets a bit more nuanced. While revenue is up, the cost of making those products also went up. For the 9 months, the cost of product revenue was about $77 million, a slight increase from last year's $76.5 million. This means their profit margin on products, what they actually keep after paying to make them, is getting squeezed a bit. This is reflected in their gross profit. For the 9 months ending the 30th of September 2025, gross profit was about $53 million. That is a big improvement from about $32 million in the same period last year, so that's definitely positive. But let's look at the gross margin percentage. It was 21.1% last year and climbed to 29.4% this year. This is a significant improvement, meaning they are keeping a larger portion of every dollar they earn after direct costs. Now let's talk about expenses. Research and development costs stayed pretty flat, hovering around $33.7 to $33.9 million both periods. This shows they are consistently investing in their future technology. However, sales, general, and administrative expenses did creep up. For the 9 months, they went from about $37.4 million to over $38.5 million. This increase is pretty standard when a company is growing, but it is important to keep an eye on it. A notable new entry is restructuring costs, adding about $1.7 million in expenses during these 9 months. They mention headcount reductions and write-downs, indicating they are making some tough choices to streamline operations, likely in China. All this financial activity led to a loss from operations. For the 9 months ending the 30th of September 2025, this loss was about $21 million, a significant improvement from nearly $40 million lost in the same period last year. So even though they are still losing money from their day-to-day operations, they are losing less, which is a good trend. And when everything is tallied up, they reported a net loss of around $18.5 million for the 9 months ending the 30th of September 2025. This is better than the nearly $36 million loss from last year. On a per S-hair basis, their loss per S-hair improved from 75 cents to 37 cents. That's still a loss, but it's half the size. Let's look at where the money is coming from. The aerospace and defense market is clearly the star of the show for N.L.I.G.H.T Incorporated. For the 9 months ending the 30th of September 2025, this sector accounted for nearly $119 million in revenue, a huge jump of about 50% from last year. This is where the company's growth is really happening. On the flip side, the industrial market saw a significant drop, down by about 23% from last year. And the microfabrication market also declined by almost 6.5%. This suggests that while their defense business is booming, their other sectors are facing headwinds. Geographically, North America is their biggest market and continued to grow, showing a 27% increase in revenue. Asia Pacific saw a decrease, likely tied to the slowdown in their industrial and microfabrication segments. EMEA, which is Europe, the Middle East, and Africa, reported a healthy 25% increase in revenue. Looking at their financial instruments, N.L.I.G.H.T Incorporated holds a decent amount in Level 1 assets. This means they hold investments that are easily traded, and their value can be seen in active markets with little guessing involved. For example, their cash equivalents and marketable securities like US Treasuries and money market funds are all valued this way. This generally indicates a solid financial footing when it comes to their liquid assets. Remember that jump in inventory we saw earlier? Let's look at the numbers. Inventory increased from about $40.8 million at the end of last year to over $51.4 million by the end of September 2025. That's about a 26% increase. This really fuels the concern about whether they are producing too much and if that stock will eventually need to be discounted or written off. Now onto their debt situation. N.L.I.G.H.T Incorporated has a $40 million line of credit. They've drawn down $20 million of that. This means they have access to more funds if needed, but it also means they are incurring interest expenses on that drawn amount, which is reflected in their financial statements. It's good they have this flexibility, especially if they need to cover operating expenses or invest in new projects. Let's talk about how they reward their employees and executives. Stock-based compensation is a big part of their expenses. For the 9 months ending the 30th of September, 2025, they paid out over $21 million in stock-based compensation. This includes restricted stock units, performance shares, and stock options. They've also granted new performance shares, like the special 2025 PRSUs, that are tied to stock price goals. This is a common way for technology companies to attract and retain talent, but it also dilutes existing shareholders' ownership over time. We saw those restructuring charges, and the details reveal they are cutting staff in China and writing off some capital equipment projects related to production capacity that never got used. This is a painful but sometimes necessary step to cut losses and focus on more profitable areas. Now, let's consider the risks they are facing. They are very concerned about international customers, operations, and their supply chain. They specifically mentioned tariffs and trade barriers, especially with China, and the potential for retaliatory actions. This global economic and political uncertainty could really impact their business, especially since they manufacture both in the US and internationally and sell to customers worldwide. They're worried about disrupted supply chains and increased costs, which could make their products less competitive. It looks like their Chief Financial Officer, Joseph Corso, is planning to sell some of his shares. He adopted a trading arrangement to sell up to 156,714 shares by the end of 2026. This is pretty common for executives cashing out some of their stock options or awards. Pass overall analysis, pass. So what is the story here? N.L.I.G.H.T Incorporated is definitely navigating a mixed landscape. Their main strength is the booming aerospace and defense market, which is driving impressive revenue growth. They are becoming more efficient, as shown by the improved gross profit margins. However, they are still losing money overall and face significant challenges. Their industrial and microfabrication segments are struggling, and that increasing inventory is a red flag that needs careful watching. The company is leaning heavily on defense contracts, which can be great, but also cyclical and dependent on government spending. They are also taking on some debt with their line of credit, which is smart for flexibility but adds interest costs. On the risk side, global trade tensions are a very real concern for them. Overall, N.L.I.G.H.T Incorporated appears to be in a transitional phase. They have a strong growth engine in defense, but need to either revive their other segments or prove they can operate profitably even with that declining revenue. The increase in cash is good, but the growing inventory and the continued net loss mean they aren't out of the woods yet. That's our take on N.L.I.G.H.T Incorporated's latest quarterly report. What do you think about their reliance on defense contracts and their shrinking industrial business? Let us know your thoughts in the comments below. If you found this breakdown helpful, be sure to give this video a like and subscribe for more deep dives. And don't forget to join the conversation on our Discord server, linked in the description. Thanks for watching, and we will see you in the next video.